As part of its simplification initiative, the FASB recently issued an ASU that requires entities to recognize the income tax consequences of many intercompany asset transfers when the transaction occurs. Welcome to the KPMG accounting update on ASU 2016-16. My name is Vicki Pollack, and I'm a senior manager in KPMG's Department of Professional Practice. During today's accounting update, we will provide some background on the issue and an overview of the changes resulting from the ASU. Under current U.S. GAAP, entities are prohibited from recognizing the current and deferred income tax consequences of an intra-entity asset transfer until the asset is sold to a third party. The seller defers recognizing, for financial statement purposes, any tax expense resulting from an intra-entity asset transfer, including taxes currently payable or paid. The buyer does not recognize deferred income taxes for any basis differences for the transferred asset. This is an exception to the accounting model for comprehensive recognition of income taxes in Topic 740. So as part of its simplification initiative, the board received feedback from stakeholders indicating that the limited amount of authoritative guidance about the exception has led to diversity in practice and is a source of complexity in financial reporting, particularly for intra-entity transfers of intellectual property. Stakeholders also provided feedback that the exception in current GAAP doesn't provide useful information to financial statement users because it requires deferral of income tax consequences, including taxes payable or paid. The ASU requires that entities recognize the income tax consequences of an intra-entity asset transfer immediately when the transfer occurs, with the exception of inventory transfers. For intra-entity inventory transfers, the board decided to retain current GAAP, which requires an entity to recognize the income tax consequences when the inventory has been sold to a third party. The exception for intra-entity inventory transfers is based on the master glossary definition of inventory, and therefore may put more pressure on an entity's judgment of what items are considered inventory. We believe that entities can apply the inventory scope exception only when the transferred asset is inventory for both the seller and the buyer. Entities should apply the change in accounting for intercompany asset transfers on a modified retrospective basis, with a cumulative effect adjustment as of the beginning of the period of adoption. The cumulative effect adjustment will include recognition of the income tax consequences of intra-entity transfers of assets other than inventory that occur before the adoption date. Entities will include in the adjustment valuation allowances, if necessary, on deferred tax assets that arise from transition to the new guidance. As companies think about interim reporting after adopting the amendments, keep in mind that the ASU does not provide guidance about whether an entity should include the tax consequences of intra-entity asset transfers in its estimated annual effective tax rate. Entities will need to apply the existing guidance in Topic 740 to determine whether the tax consequence of an intra-entity asset transfer represents a significant, unusual, or infrequently occurring item that should be recognized as a discrete item in the interim period of the transfer. In terms of disclosures, in the first annual period of adoption, including interim periods, entities will need to disclose the nature of and reason for the change in accounting principle. They will also need to provide quantitative information about the effect of the accounting change on the financial statements in the period of adoption. The ASU does not include any new or unique disclosure requirements. As shown in the table on the slide, the ASU is effective for public business entities for annual and interim periods beginning after December 15, 2017. For all other entities, the ASU is effective for annual periods beginning after December 15, 2018, and interim periods in fiscal years beginning after December 15, 2019. Entities may early adopt the ASU, but only at the beginning of an annual period for which no financial statements, interim or annual, have been already issued or made available for issuance. SEC registrants who have not yet adopted the ASU should be mindful of the SAB 74 requirement to disclose the expected effect adoption will have on the financial statements, unless that impact is not expected to be material. Thank you for listening to KPMG's accounting update on ASU 2016-16.